Hey, what's up you guys? Welcome back to the channel. So today I want to talk about how you can get more money back on every paycheck. So the average tax return for the 2018 tax year was about $2,725. That works out to be $227 a month. This tells me that Americans are giving away too much of their money to the government every time they get paid. So if this sounds like you, this video is for you. So let's talk a little bit about how tax refunds work. So each time you guys get paid, there's a line item on your pay stub that says federal withholding, and if your state collects taxes, you'll have a state withholding as well. Sometimes it'll be labeled like federal tax withholding, federal withholding. All of those mean the same thing. So that line item is just a credit to the federal government, and when you actually file your taxes, they already know the amount you've paid in, and so whatever you end up owing, they'll just subtract the difference, and what ends up being the difference is your refund. So you can see the average is about $2,725 that people are overpaying on average. So one thing I wanted to point out is that the government is pretty clever, and they know that, in order to get their money and guarantee their money, they're going to take it out every paycheck. And it's almost like a form of paying yourself first. And they know this works because it's automatic, it's in payroll deductions, and it's even before you even see your paycheck. And most people don't mind, they just complain about it and they just move on with their lives. Now, if you're like me and you didn't get a really big tax return, well, why are you in this video? You should have left earlier. But if you are still here, you should be celebrating, and let me tell you why. Overpaying the government is probably one of the dumbest things you can do. And what I mean by that is, it's like giving your friend an interest-free loan for $227 a month each month until the end of the year. And not only that, you have to pay a fee, file your taxes, and even wait a couple days before you even get your money back. In what insane world is that okay, guys? I don't know. So you're probably wondering, how do you fix this? So the withholding line is solely controlled by the W4 form. And I'll put the form up on the screen here so you can see what it looks like. Filling out this form properly is going to maximize your paycheck and ensure that you pay less overages to the government. Now you're probably wondering, what the heck is this form, and you've never seen it before in your life. Well, believe it or not, when you first started your job, you had to fill out a W4 form, and most likely you had no idea how to fill it out. I'm guilty of that. Now, if your life changes and you have life events like getting married or having kids, most likely that form isn't filled out properly, and most likely it's still the same number as you had it before when you first started your job. So what you want to do is make sure that you update that form and fill it out correctly for your current situation. Now, if you're single and you put 1, it's most likely okay because that's probably the correct number to put. But if you're a low income earner or you have children, then most likely it's not set up properly and you're getting a big tax refund. You could also own a house, you could also donate to charity, so there's a lot of different factors that affect your taxes. So it's best to update this thing periodically as your life changes. So let me show you how to fill out this form so you can maximize your paycheck and minimize your tax return. Yes, I said it, minimize your tax return. So believe it or not, the IRS actually has a website dedicated to filling out a W4. And they've done a good job with it recently. I remember in the past when I used it, it was just literally a piece of crap website that, just had a bunch of boxes. Now it's a little bit more interactive. It's got some, questions that they ask you, and it actually even generates the W4 document for you so you can print it and give it to your HR department. So let's take a simple example and let me show you how to run through this. Alright guys, so here's the example. So what you can do is you can Google search IRS Tax Withholding Estimator, and it'll take you to a website like this. This is the official IRS website. And what you want to do now is go down here and click on Use Tax Withholding Estimator. And in this example, we're going to do a simple example. We're just going to do an average family of 3 with a single income of $100,000 a year. So what you want to select here is married filing jointly, because when you're married, you're most likely going to file jointly on your tax return. Down here, you're going to put no because no one's going to claim you as a dependent on their tax return. And then here, it's going to ask you if you have any dependents. So in this example, we have 3 kids. So we're going to put 3. And then it's going to ask you if you're going to make any income this year. You're going to put yes. And in this example, we're only going to have 1 income. So we're just going to put 1 income here and 0 for your spouse. And here it's asking if you're going to receive any kind of pension. So we're going to put no. And I'm going to leave all these unchecked. But if you want to read these and go through these because you may qualify for them, you can go ahead and check these boxes if they apply. Here it's asking if we expect to hold a job for the entire year. And we're just going to assume yes. And it's asking you how often your payroll is processed. And here it's asking you for some information in your last paycheck. So this is assuming if you're like mid-year and you're watching this video and you're trying to calculate how much you have to pay. This is going to take into account some of the information that's on your pay stub, so the amount that you've already paid in, to kind of decide if you need to pay more or pay less in the second half of the year. So to keep this simple, we're just going to select January 3rd because Fridays are a pretty common day to have payroll processed. And then, like I mentioned, we're going to put 100,000 here, And then here we're just going to put 0 for bonuses. So here it's going to ask you for information from your last paycheck. So if you are doing this mid-year, you'll have pay stubs that already have some of this information in there. I'll show you a sample of what you put here. So let's just pretend that this was your paycheck. So you'll go to the federal tax row and just look at the year-to-date total and the total for that last paycheck. So you'll enter these two numbers in there. So for year-to-date, 756 and 108 for this amount here. So in this scenario, we're at the beginning of the year, so we're just going to put 0 for the sake of this video, but you would put those numbers there. And then down here, if you are contributing to a 401k, you can enter these, but for the sake of this video, we're just going to put no to both of these, the HSA and the 401k. In this screen here, these are additional tax write-offs that you may have. So if you have student loan interest, you can put here. If you paid into an HSA account on the side and not through payroll, you can put it here. If you had a traditional IRA, you can put it here. But for the sake of this video, we're just going to keep all of this empty. And then here, most likely you're going to be in the standard deduction range. Myself, I have a pretty high income last year, and most likely I will still take standard deduction. But if you have a really big mortgage or you have a lot of donations, you might meet the requirement to itemize, but most likely you're going to probably take the standard deduction. And then for tax credits, we are going to fill one out here, and that is the child tax credit. So we have 3 kids, so we're going to put that there. The rest of these, if you have some of these, then you can go ahead and enter it in. But for this example, we're just going to leave everything blank. I found that most of these I don't qualify for. If you're a low earner, you may qualify for earned income tax credit. If you have like solar panels or you did energy efficient upgrades to your house, you may qualify for some of the other items in here like energy efficiency or home ownership energy upgrades. So here it's telling me I'm going to be short $2,632 if I don't change my W4. And if you scroll down a little bit here, you'll see that it actually tells you what you need to do to kind of fix that so you don't have a penalty at the end of the year. And it's telling you that you have to withhold at least $110 for each paycheck. And right now it's not withholding anything because it doesn't know how much I'm withholding. It even gives you a download form, so you can actually download this document. And it's already pre-filled out what you need for your HR department. So you can just take this and give this to your HR department and they can process it. Obviously, you'll need to put your name in there. You'll need to put married filing jointly again. And then this number is already pre-populated. And if you enter some of the other numbers, these boxes will be filled as well. These are the deductions and some of the other itemized items, like student loan interest. So they'll put some of that in here for you. And then you'll just sign this and give it to your employer. And what they'll do is they'll update their records, and based off what you make, they'll kind of just decide how much to pull out every paycheck. And the ultimate end goal is by you doing that, you're going to have a tax refund of $0 or close to it, or maybe even a small refund back at the end of the year. If you scroll down, you can actually see all the information that you inputted. So here we have $100,000. You can see we took the standard deduction, and that's going to subtract from that. And really the taxable income that they're going to use is $75,200. And if you calculate that based off the current tax brackets, it's going to be $8,632 in taxes. But fortunately, we have 3 kids, and the 3 kids qualify for a $6,000 tax credit. That's basically $2,000 per kid. So you subtract these two numbers, and you get $2,632. So at the end of the day, a family of 5 making $100,000 annually only pays $2,632 in federal taxes. Now there are other taxes, and that's kind of where things get a little crazy. If you live in the state of California, there's state income tax, there's state disability insurance. There's also other federal taxes like Medicare and Social Security. And when you kind of add all that up, yeah, the taxes can get kind of high. But in this scenario, this federal portion is actually pretty low. And this is without doing anything. I didn't buy a house here. I didn't put in my, mortgage interest. I didn't pay property taxes. I didn't do any of that. I didn't even contribute to my 401k. If you decide to do some of that, you'll see that you'll actually end up paying no taxes. So let me show you that really quick here. So here I'm going to start over. I'm going to put the same exact information as I had earlier. And the only difference that we're going to do now is we're going to put that we're going to contribute to our retirement account. So down here, you can see all the information is the same. The only difference we're going to do here is we're going to contribute to our retirement account. And what I want to do is max out my 401k. So, it's $19,500 for 2020. And then here, I'm going to max out my HSA. It's $7,100 for a family in 2020. And what this is ultimately going to do is it's going to reduce your taxable income by about $26,000 here. So let's go ahead and just go to the last page and take a look. And we're going to put our child tax credits back in. And you can see here, now I have a 0 tax bill. This is just telling me that I'm not going to have any trouble owing money at the end. But if you scroll all the way down, you'll actually see that if you do the math here, this is $5,440 in taxes you'll pay. And then the tax credit for the 3 kids is going to give you $6,000. So you'll actually get a tax return in this scenario in the amount of $560. And if you look at some of the math, you'll see here you made $100,000. Your HSA and your 401k totals $26,600. So if you do the math on that, your income really is just $73,400. And if you take the standard deduction, which everybody gets if they're married, it ends up being $48,600 that they use to calculate your income taxes, which ends up being $5,440 in the current tax year. And then if you calculate the child tax credits, you end up coming out positive. So this tells me that you can make $100,000 and have 3 kids and max out your 401k and max out your HSA and literally pay no federal income tax, which I think is pretty great. Now you're probably wondering, what if I put a really large number in that box and I try to avoid paying taxes altogether? Well, the IRS is a little bit smarter than that, and they have already accommodated this, and they call it the underpayment penalty. What the underpayment penalty is to make sure that you have paid at least 90% of what you're going to owe them each quarter. And so when you actually file your taxes, if you use any online tax software, it'll actually calculate this for you automatically, and it'll kind of determine if you have a penalty or not. The penalty isn't that much, but it's enough where you don't want to hit that penalty. So my suggestion is to try to make sure that you pay 100% of your taxes in your payroll and not any more. And you can always go a little bit less because there's a little bit of buffer room there, but you definitely don't want to go over because you're going to have a huge tax return. So what do you do with all this extra money? You just got an extra $200 back or maybe more after every paycheck. And I know like a lot of people, you're probably going to end up spending it on dumb things or end up not saving it. So what I suggest you do is you go and open up a new account and automatically send money to this account as if it was like the IRS. What this is going to do is it's going to simulate kind of like a savings account, because that's what people think the IRS is. It's a savings account. And what you can do is you can open a separate savings account. You can do this through your credit union, your bank. I don't suggest those places because they don't really give you a good return on your money. But if you want to use an online bank that I use, it pays about 1 to 2% in interest every year. You can open up one of these accounts and set it up so that it automatically takes money out and puts it in there every single time you get paid. The whole point of this is to make sure that it's automatic, because if it's not automatic, you're most likely not going to do it or forget to do it. But what you can do is every time you get paid, so every other Friday, that $200 you just saved, you just automatically send $200 to the other account. And I'm going to show you an example of what I do on my account so you can see. Alright guys, so here we are logged into my Ally savings account. You can see I don't have a lot of money in here. I actually have no money in here because it's only earning 1.6%. There are better accounts, and I'll leave a couple links down below in the description for you guys. I use Wealthfront, and I used to have a CIT bank, but I still have my Ally account, and I'll show you it works the same way. All you need to do is add your primary banking account to this account, so that way you can transfer money between it. It's a one-time process. And what you can do is go up to transfer here, and all you need to do is just set up an automatic transfer from your primary account to your savings account. And you can see here I have Educational Employees Credit Union. It's just a local credit union to my city, and you can just put that amount here. So earlier we mentioned $227, and that's monthly, so this is probably going to be bi-weekly, so it's probably going to be around $100. And then what you want to do is just do every 2 weeks. And here on the calendar, so you just pick a date and make sure that it aligns with your payroll, and then have it transfer every other Friday, so that way you don't have to think about it. And this way it ends up being exactly the same as if you were to send it to the federal government through the federal withholdings. So in this scenario here, every other Friday, it's going to take from my primary checking account and transfer it to the savings account. And the nice thing about that is once it's in this account, it starts earning 1.6%. And also you get the added benefit of it being available anytime you want. So you can easily just transfer this money back into your primary checking, for example, and it'll only take like 1 or 2 days to get there. So now come tax time, when your friends and family are waiting for their taxes, you can just log into your Ally account or whatever account you end up using, and you can see there's probably going to be $2,400 in there, which is what you would have gotten in your tax return anyways. The nice thing about this account is you can always transfer that money back into your primary checking account in the event of an emergency, or in the event you want to go on vacation, or in the event that you just want your money. You have access to that money at any time, whenever you want. So That's kind of the downside of putting it into the IRS savings account. You actually can't touch it until you file your taxes. And the cherry on top is you're actually earning 1 to 2% of interest on that money. So the point of all this is to just make sure that you get more money now, so that way you have it available to you. You can invest it, use it for emergencies, or just use it to live. You may be living paycheck to paycheck, and this extra $200 or $300 a month is going to make it or break it for you. And just by having that money now and not having to wait till the end of the year for it. What I see a lot is people getting a lump sum at the end of the year. It may be $4,000, maybe $10,000. And what they end up doing is just blowing it all away and throwing it out the window. They go and buy a new car, they go and give their friends, free dinners, or they go and throw a party, or they go on these crazy vacations that they couldn't afford to begin with. You also get the added benefit of investing some of it as well if you want to go that route. And it's all about just being smart with your money and making sure you're making your money work for you instead of just sitting there idle doing nothing. Even earning 1 to 2% in the high yield savings account is better than losing money to inflation. Well guys, that's the end of the video. Hopefully you found these tips helpful. If you did, please like my video. It helps my channel a lot. If you guys are interested in more videos from me in the future, please subscribe to my channel and hit that notification bell so you're aware of when I upload a new video. As always, have a nice day and enjoy your new paycheck.